Good afternoon, everybody. Dialing in to today's live stream from Europe. Good morning for everybody joining us from the Americas, and good evening to everybody listening from out in Asia. My name is Lutz Preussler. I'm responsible for the business development efforts of the asset management side at Sygnum, and I would like to welcome you to our May investment outlook. Thanks again for joining us. This month, just like last month, our head of investment research, Katalin Tischhauser, is here to walk us through some of the biggest news in crypto and questions we're currently watching right now. As always, all content and opinions presented in this live stream do not constitute any investment advice. So let's dive right into it. After April, we figured that macro is a very, very big topic, and we need to talk about the macro. When we sat down and thought about what else should we talk about today, the answer continued to be macro. Just it looks like the signs have changed a little bit, and there have been lots of movements, especially over the weekend and in the last 24 hours. So, Katalin, what on the macro front should investors be watching?
Well, obviously, it has been about tariffs. It's been the biggest driver to the downside and to the upside recently, a massive shock a month or so ago, and then some dramatic developments and U-turns ever since. So it's overpowering everything else. It's overpowering economic data and so on. So we have to talk about it. And as you say, the news flow has turned positive recently on the tariff situation. And risk assets accordingly have been recovering. The risk metrics are down, the VIX is way down, even the bond volatility is down, although treasury bond yields are not doing that great, but that's a separate story. But risk assets have been recovering, and obviously with the news overnight or over the weekend / overnight, the S&P is now opening up almost 3%. So it's a very positive backdrop, and the US-China trade truce specifically is a dramatic positive development. It's of course a 90-day pause, let's say, on those tariffs, and negotiations are still to happen beyond what they had already agreed, which is quite momentous, which is this trade truce. And the way I see it, and the reason why I see the trajectory also going forward as positive and the likely, of course, we cannot be sure how everything works out, but my expectation is that it is going to move in a positive direction. And the reason for that is that when the US came out on the 2nd of April, they said, this is to reindustrialize America. And the policies were not actually consistent with that. That's not what you would do if you want to reindustrialize America. You would have had different policies in place. Tariffs could and should be a part of it, but you would have had other policies alongside it to do with infrastructure, which is clearly an issue, to do with education, basically have a whole policy package that makes sense. But much more importantly, you wouldn't have jeopardized critical supplies, including to the defense industry. You would have coordinated with business leaders instead of having them caught off guard, and then up in arms about what the tariffs are doing potentially to their businesses. And maybe most importantly, the US wouldn't have asked other countries to cut off trade with China. And which is something that Scott Bessent mentioned, that they want to use the 90-day pause on the other tariffs to use the negotiations to achieve that goal, to isolate China economically. And basically, reindustrializing the US and reducing China dependence is a positive goal. Policies that actually get us in that direction, move us in that direction, are positive for the US economy and not necessarily too destructive for the world economy, although obviously some of it is zero-sum, and there's a bit of the US wanting to take back market share in certain things. But all in all, that's not a destructive situation. If the US sets out to isolate China as a geopolitical goal, sacrificing even US economic objectives, that's destructive for the US and very destructive for the world economy. And I think the US, first of all, the policies that they started out with on the 2nd of April look much more consistent with setting out to achieve geopolitical objectives than setting out to reindustrialize and revive the US industry and economy and help the US worker. And they also thought that they had a strong hand. This is something that both Trump and Scott Bessent repeatedly said, that the US has the strong hand and everybody will come running and China will come running. And actually, basically, these policies hit a wall, and reality has been forcing the US onto a different path and a much better path, and actually a pretty good and constructive path. What we have seen with the China meeting, first of all, China's claim that the US asked for this meeting was actually confirmed by Western media. So it appears that despite the posturing and pretending that they just bumped into each other in Switzerland, the US actually backed down in that sense. And they also agreed to China's core demand. China's core demand for the negotiations from day one was take off these punitive tariffs that you started out with 145% or whatever, which is basically what this trade truce does. It removes that tariff that the US put on China, and of course also the tariff that China put on the US in response to the tariff that the US put on China. So seeing this, it's telling me that the US is now on a reasonable path, and it's moving in a direction that is, once they have been able to ask for the meeting and give in on this core demand, I think it's quite likely that the negotiations will be reasonably constructive, and we're going to have a reasonable outcome. So the markets are pricing this in. Now, there's of course also the tariff negotiations with other countries, and the first trade deal that was signed with the UK. I think that's less significant, in the sense that, first of all, the UK wasn't particularly targeted with the 2nd of April tariffs, so there wasn't that much even to talk. There is always things to negotiate and talk about, but also these agreements that are signed fairly quickly, and trade negotiations can take years and years. So agreements that are signed in a couple of days or weeks or a month, let's say, are necessarily very high level and vague, and ultimately, as the details are worked out later on, which is still in the future, it can end up looking quite different than the very high level. So I think it doesn't mean a lot, and there'll be probably, in fact, almost certainly similar agreements signed with other countries as well. But I think they will also be fairly high level and short on detail, and we'll find out later on how everything works out. But generally, it's all a positive signal. The signaling from all of this is positive. I think the 10% tariffs will remain, and I think the US, of course, does want to reindustrialize. So I'm of course not suggesting that that's not something the US needs to and wants to achieve. I'm merely saying that was not the primary objective, and the initial policies did not stack up to serve that primary objective. But with the tariffs and with a better set of policies, I think the outlook is now pretty positive for the tariff situation and for risk assets and financial markets.
Right. Okay. Exactly. And you brought up a couple of interesting points, right? That I would maybe go back to. The question the question that comes up is like, why go through this entire exercise in the first place, right? You said now that the US is on a better path now than it of course was before, and it's more in line with what they stated on April 2nd. I mean, is this going through this exercise just a microcosm of how policies are being done under Donald Trump and reflective of the president's behavior? And do we have to expect it again, even though you mentioned you hope it doesn't happen again, right?
Mm-hmm.
What?
Yeah, interesting. Interesting you raise that, and because actually, that is a lot of what is behind my thinking, that if you wanted to have 10% tariffs, if you wanted to have tariffs on certain industries, there was absolutely no need to tax the penguins on uninhabited islands, and to put insane tariffs on Vietnam and Switzerland and all sorts of, like every country around the world, even the uninhabited countries, islands without a port. You could have just introduced those policies without shocking the world. So the shock had to serve some purpose, I imagine, which is that the art of the deal, you propose something crazy, then you pull back, and then you can get your other demands through much more easily that you couldn't have gotten through easily. And those demands would have been to ask for countries to cut off China. And that's not really worked. Even Japan didn't want to agree to that. In fact, Japan, Korea, and China got together coordinating their response to at least having talks about it, which is the first time these countries talk on economics in like 5 years. So actually, the response was not what the US expected, but I think this shock had to serve a purpose, because if they just wanted to protect certain industries or the US economy, that could have been done without that. So, yeah.
Right, exactly. And of course, everything that has happened over the last 48 hours, 24 hours, has a direct impact on the big topic that has been driving markets, and it has been inflation, which ultimately leads us to the US economy and the Fed, right? I mean, having digested these last couple of hours, we've seen ultimate reaction: strong dollar, super strong dollar, strong equity markets, you highlighted, right? What's the trajectory for the Fed, and what should we look out for going forward?
Yeah, it's very connected, as you say. Currently, everything is connected to the tariff situation, and I think we have seen some very big moves in U.S. assets over the past month, especially Treasury bonds being sold off, the dollar being sold off, and it is also the last question, the last point you raised, because a lot of the world looking at what's happening in the U.S. actually concluded that the administration is not very competent, and therefore lost a lot of faith in U.S. assets, including and especially government bonds. I actually, as I said, just before, I have a different take on this. I think this was deliberate, somewhat made up on the fly in the detail of it, but fundamentally a deliberate path that they were following, rather than just bumbling and being incompetent. But it definitely led to a lot of loss of faith in U.S. assets, which is impacting, of course, also on the Fed's policy and their latitude, what they can do. Now, rate cuts are pushed out further and further in the future. After the 2nd of April, the June rate cut was traded at 100% probability. Now it's 15, and of course last week we didn't get a rate cut, and it's all basically getting pushed out further into the future. Now, Jerome Powell has stated many times since the tariff talk started that he wants to wait and see. So that is definitely part of it. The Fed thinking that until there is visibility on the impact, they don't want to make a decision, and they can afford to wait. Actually, I think Powell put it last week that the Fed is in a good place where rates are and where the policy is, and they can afford to wait. So that's definitely been their preference throughout. But on top of that, Powell talked about stagflation. He didn't use the word, but talked about downward pressure on growth and upward pressure on inflation. So that's that. I think confidence, when we look at what's happening to Treasury yields, they're still drifting upwards. So I think the market is still not regaining confidence in US assets. And of course, the budget deficit has been rising despite DOGE. US debt continues rising, government spending continues increasing. And there is this, how the policies were handled and how it appears definitely led to a loss of faith in treasuries and so on, but also then Trump recently threatening the independence of the Fed and suggesting that he should be dictating interest rate policy and possibly even fire Jerome Powell, which of course he can't. But and then he backtracked from that. But those attacks on the Fed and Powell also dealt a further blow to the confidence in U.S. assets. And actually, Warren Buffett also dealt a further blow when he resigned. His parting shot was to say that the dollar was going to hell, and he would invest in a basket of other currencies. And of course, Buffett was always a very, very, very long-term investor. And to be honest, it's very hard to see that over any kind of short-term horizon, there's so much demand, built-in demand for dollars that this wouldn't be very imminent. But Buffett's horizon was never the short term. And in terms of rate cuts, it's also against this context. It's also important to highlight that actually rate cuts would be counterproductive. So I'm not sure why Trump is insisting on it so much, because we already saw that last September, that when the Fed cut 50 instead of 25, bond yields shot up. Basically, the market assessing it as this is going to be inflationary, this is money printing. And in the current context, with tariffs possibly almost certainly putting upward pressure on US inflation, this is even more so. So I think if the Fed did cut rates now, bonds would do even worse. And that's actually affecting the government much more because of the rates on government debt going up. It's also affecting corporates who borrow and mortgages and so on. So it would actually be extremely counterproductive. I think if the Fed/Treasury make moves to provide liquidity, they will do it differently, not through rate cuts over the short term. And the other point I wanted to make is that we're getting, of course, a lot of economic data all the time, but I think at the moment, probably the data are not very relevant, and the market doesn't trade the data too much, because anything that happened before the 2nd of April is now this, maybe we had good news on something, but that's before tariffs, so it actually no longer matters. The negative GDP was highly technical in Q1, the minus 0.3 contraction, because it was just simply GDP is calculated by subtracting the imports. It's part of the GDP calculation formula, and when imports were fast-tracked to get a lot of fill up inventories ahead of the tariffs, that artificially created a negative number. So again, it's not a signal, for example, for the Fed to suggest that there is a greater, we're already almost in recession, and therefore they would have to cut rates. So these economic data are largely ignored because of the tariffs confusing the readings. And I think that's going to be the case going forward as well, because now the situation is getting very much better. So we probably get some very bad numbers for April or for the current month, but then the market would conclude that that's a one-off, that's already in the past, that's reflecting this negative initial situation that's already been addressed or is being addressed, and therefore the data won't matter that much. I mean, we could have a technical recession, which is defined as 2 negative quarters, because we already had a negative quarter, and we can have some very bad numbers for the current quarter just because of what happened over the past month. But that actually, I think that actually the market will look past that. And I think what really matters now is that the US-China trade war appears to be off the agenda. The tariff situation is clearly improving, and global liquidity is increasing. The dollar, which has weakened so much over April, is contributing to this. And generally, with a more slowdown global environment, of course, central banks, the ECB cut 2 weeks ago, and that's generally the trajectory. And of course, China is very likely also to provide liquidity injections to help with the loss of export markets. So I think that all in all, this is a good backdrop for risk assets.
Right, exactly. And I think it's a good time to remind ourselves that the mandate of the Fed is not to engage with whoever is in the Oval Office, but it's a dual mandate with respect to full employment and price stability, right? And this is what they're watching out for. So similar to the trade war from a macro perspective, where it's a lot of noise, you need to like funnel through the noise and look through the noise and focus on the fundamentals ultimately, right? Yeah.
I completely agree.
Yeah. Okay, great. So maybe let's move onto the next topic a bit and put it into a crypto perspective, right? Because of course, macro and liquidity conditions are very, very relevant in this environment, and couldn't be a better example of walking through it, right? So let's talk about Bitcoin and the decoupling from traditional risk assets, right? In your opinion, is Bitcoin becoming a store of value, and is it traded like gold, and is it becoming a safe haven, so to speak?
Yeah, I mean it's one of the big questions, and something that's much talked about in the crypto industry, especially currently. And the first thing I would say is that even though the macro environment is improving for risk assets, I think safe haven demand is likely to remain strong for a while. There's a lot of uncertainties that remain, and a lot of risks. The tariff agreements are for now quite vague, lack specifics, or are temporary. It's a temporary pause. There's still a lot of risk on how this will end up and how it will look in the detail. The bond markets are nervous, as we mentioned, for a number of reasons. The U.S. bond treasury markets. The Sell America trade is still in play for now. We'll have, especially with regard to treasuries, maybe the environment for demand for U.S. stocks could improve if really the policies will be a reindustrialization and pro-growth environment in America as a policy package. But fundamentally, there's a lot of risks that remain, and of course the already mentioned massive and growing indebtedness of the U.S. government and other Western governments, and the growing budget deficits and so on. These create such fundamental instabilities, and the fact that there is no change in the trajectory, and even despite all the narratives of this new administration of cost savings and 2 trillion savings and creating Doge and cutting costs, there's actually no change in the trajectory. Government spending is still increasing, the deficit is still increasing. So all of these create such fundamental, deep uncertainties that I think the demand for risk assets is going to continue to remain strong. And now that raises the question: if we have a decent environment, for safe haven assets is going to remain strong. So if we have a decent environment for risk assets, but continued demand for safe haven assets because of the underlying uncertainty, then it will be a little bit difficult to tell, if Bitcoin rises because it's going up with risk assets, or it rises because it's a safe haven asset. But in the past months, we have seen signs of decoupling for sure. We have seen situations where the risk asset environment was negative and Bitcoin was at the very least steady or selling off a lot less, even though it should be much more volatile, or even sometimes moving a little bit in the opposite direction. And over the months since the 2nd of April, it kind of decoupled from risk assets on evidence. So there is a shift in that direction. Bitcoin is fundamentally not a risk asset. It's not really used as a tech platform. It's not a tech play, and any revenues that are earned on Bitcoin are paid to the miners, so they don't come to the value of Bitcoin, the asset, and it gains its value from its safe haven properties. So it's fundamentally not a risk asset, but it's traded as a proxy for the crypto market by a lot of people. And a lot of the crypto industry is a tech play. It's a new technology, all sorts of applications potentially building on it, or to some extent already having some success and great future growth expectations and so on. So it's reasonable that the blockchain industry and the applications that build on it and the platforms that the applications build on, all of that it would trade like a tech play. but Bitcoin is really quite different. However, it trades like a tech play because a lot of people just say this is my proxy investment in crypto in general. So where Bitcoin is currently is a little bit hard to tell apart, but there has been a clear move towards it being regarded as a safe haven asset. And this is something we observed. We have also heard about gold to Bitcoin rotation. And also this safe haven narrative is very strongly communicated by key business leaders, key opinion leaders, the US administration. And now as the icing on the cake, and maybe even a turning point where this can accelerate the first US state approved Bitcoin reserves.
Yeah, exactly. That was going to be my next topic, right? I mean, fundamentally, there's also been like news over the last week from that front. So it's not just the market moves and the correlations and the decouplings, but walk us through the fundamental changes that are there now finally in the US.
Yeah, it's been pretty eventful. It was a long time coming to get, other than the executive order, which is only moving the seized Bitcoin. So when they start actually buying Bitcoin at the federal level, I think that will be pivotal again. But for now, it has been a lot of expectation, and actually more than half the states initiated these Bitcoin reserve bills similar to the federal level Bitcoin Act, but the approvals were not going well. 4 states rejected the bills. 1 passed but omitted the actual Bitcoin reserve provision. So basically, it's almost might as well have rejected it. And the first state that passed it, which was Arizona, and was sent for the governor to sign it into law, the governor vetoed it instead. So there has been a lot of up and down, hopes and hopes dashed. But then a few days ago, we got the first state, New Hampshire, to approve a Bitcoin reserve bill. And I think it's a very, very, very significant pivotal development. It basically puts Bitcoin into that category, and we'll have to see who else gets on board. But it's a signal not just to other states and other governments. Now we have the Irish, one of the candidates in the Irish elections is also part of his platform is Bitcoin reserves for Ireland. And I think the fact that because even executive order, it is just what Trump wanted to see happen. So the first vote that's supported by the Senate and the House of that state, and it's gone through all the committees and it was signed into law. I think it's really a very important step in this direction. And it also influences potentially, we'll have to see, but corporate treasuries to see it. Okay, so now it's treated as a reserve asset, so maybe we should also consider it as a kind of safe haven insurance, a small percent of our treasuries. And then, so this is very positive for demand. And then we have, of course, other sources of demand that are also pointing in the same direction. Basically, we're seeing a lot of demand coming towards Bitcoin. There are these Bitcoin acquisition vehicles like, MicroStrategy or NAV Strategy, having been, of course, the main one, and quite a few, a couple of dozen copied what they're doing, but these were all very, very, very tiny companies. So in terms of the total purchase, it was still just MicroStrategy that made up like 98% of it. But now that's also changing because there's a new fairly large entity, Tether, SoftBank, and Cantor Fitzgerald created another one of these Bitcoin acquisition vehicles with significant capitalization and plans to buy more. So there's demand coming from that direction as well. And the institutional demand remains very steady. In the past 4 weeks, we had 6 billion inflows into the Bitcoin ETFs. And these allocations actually are not so much, I don't think these are in response to what's happening in the market. So, the Federal Reserve didn't cut rates or the macro, or not even the tariff situation. I think these are the results of fairly slow approval processes going on inside these institutions, and then eventually coming to fruition where they say, we will add it as a potential asset into our strategic asset allocation, and then the tactical allocation can be gauged based on market conditions. But the decision that this asset should be part of our asset mix, that decision is not market dependent, and it's ongoing. These conversations are still ongoing at several very, very large institutional investors, sovereign wealth, large pension funds, and so on. And we're also seeing platforms coming online, offering crypto trading. Schwab is talking about it, and there's constant news flow on more and more traditional financial institutions either making allocation decisions or offering it to their clients as some sort of platform or vehicle.
Right, exactly. And this picture, right? I mean, or this fundamental picture that now is changing just fits into the narrative that we've been reiterating, especially in the second quarter and towards the end of the first quarter, like fundamentally where prices are and what's fundamentally happening in the industry with respect to adoption was just not reflective of the changes, right? So it's very, very interesting to see. And having said that, and there's been, of course, a lot of attention on Bitcoin, someone that has not gotten that much attention seemingly has been Ethereum, right? Sentiment seemed to have been low, and like nobody really seems like has paid attention to it. Like of course, that has changed over the last 5 days a lot in terms of price action. But what's fundamentally happening within the Ethereum ecosystem, and where are we headed, and why might that be a reason where prices were up until 5 days ago?
Yeah, interesting, and indeed, these were the two major developments in the last couple of days: is the big move on the US-China trade war and the big move on Ethereum. So the most exciting and very influential on the crypto market and Ethereum since the last upgrade a few days ago. The Pectra upgrade is up 50% or thereabouts, 50, which is obviously tremendous, especially after what you say, for years Ethereum's been out of favor now. Now the question is, why the move? And of course, when an asset is extremely undersold, then if there's a positive impetus, then of course the move can happen fast, especially in crypto. But I think it's probably, even though the timing sort of coincided with the last upgrade, and of course the upgrade is positive and increasing the staking limits and all of that, it's all always good and important things. But I don't think the upgrade was that momentous, and I don't think that the market was that excited about the upgrade itself, and that this would be the reason behind the move. Over the last few weeks, first of all, Ethereum has pivoted on their long-term strategy, at least so they say. And moved forward after a lot of criticism that layer 2s are cannibalizing the layer 1 revenues, and that value is not accruing to the token itself. Of course, Ethereum became inflationary again over this period, and so various items that were on the roadmap that were going to happen in a year's time, several years' time, were brought forward, which is to scale the layer 1 itself and bring more business back to the layer 1 in that way, and also to improve the user experience with Ethereum, basically to catalyze a lot more activity directly on the layer 1. So I think this strategic pivot was the most significant. There have been other announcements, reshuffling of the foundation, various changes that have happened over January, February, and so on this year. But I think this is the one that the market can relate to and say, okay, this could actually make a real difference. And there was also news, like apparent news going around in the last couple of days, that Ethereum turned deflationary again. Now, certainly fees and revenues have shot up in the past week, and it could be that this is actually true. However, it could also be because that it was just wrong data, because the website that shows this kind of data was then taken down, and there's a message on it now that there were problems with the data feeds, and we're not actually sure. So it could turn out that it has not yet turned deflationary again. But just based on the fact that revenues and fees have really shot up in the past week, maybe it has. So we'll have to see. But definitely the market thinking that Ethereum is deflationary again definitely got a lot of people extremely excited. And also we just have to keep in mind, which is also something we published a note on a couple of days ago, that in the use cases that have real traction and stability, i.e. not meme coins, and especially the use cases that traditional finance is supporting and going for, stable coins, tokenization, decentralized finance, Ethereum still has an overwhelming market share. The US regulatory changes that will support these use cases and create an environment where innovation here can thrive, it still has to primarily benefit the market, the overwhelming market leader as a platform for all of this, which is Ethereum. And the security and stability of Ethereum is really very highly priced, especially by TradFi. So when we're saying that Solana is competing to be the rails of the internet capital markets and so on, Solana still had quite a serious bug recently, in last week or so, and just doesn't have the longevity and security. So I think that is still a positive in favor of Ethereum. So I think for all of these reasons, it looks like the narrative is now really shifting on Ethereum. I think there's a slight risk that if it turns out that it did not turn deflationary and actually that was just wrong data, that maybe that knocks sentiment back a bit. But the other fundamentals are still there, and the market is, after like 2.5 years of paying no attention, I think now it's latching on to those fundamentals.
Okay, super interesting. Yeah, and we definitely need to watch. I mean, the big use cases, like you highlighted, right? Tokenization, decentralized finance. I think this is what adds value and is the disruptive part of the technology. So thank you very much. I think we ran a bit over this time, over our scheduled half an hour, but I hope everybody enjoyed it. That brings us to the end of today's live stream. Thanks everybody again for joining for this super interesting session. Big thank you to you, Katalin, for unpacking these important themes, of course, that drive the industry. For a deep dive into this and other important topics driving crypto markets this year, download the April Investment Outlook published by Katalin on our website. You can find it on the website under the Learn section in Research and Education. And there you will also find... May. Okay, I'm sorry. The May Investment Outlook, correct? Yeah, because we are in May. Yeah, right. I apologize. Yeah, and there you will also find the educational piece on Ethereum versus Solana, comparing the two ecosystems, and to draw a little bit more attention onto Ethereum after we felt like it was left behind a little bit, even though now it seems like it has changed. Please also visit the Sygnum website and join our over 40,000 membership community on LinkedIn. Stay up to date on our launches, news, and research. And thank you very much, everybody.